Hello guys, so today's video is all about pattern day trading rule, right? And one of my subscriber actually recently asked me this question on how it works. So I'm gonna go deep dive in this video. I wanna tell you what it is, how it works, and more importantly, what happens if you break the rule, right? And also I'm gonna show you in Robinhood platform where you can see this setting and how you know that whether you are about to break the rule or not and the consequences of it. So all that we are gonna discuss in this video. Stick around, and with that, let's start. Okay, so the first thing, right, what is the pattern day trade rule? So this rule was a regulation that was set by SEC in 2001 to protect new traders, right, from the excessive trading. So that was the main idea behind introducing this rule. And one of the things about this rule is if you have a margin account and make more than 3 day trades within a rolling 5-day business period, your account is flagged as a pattern day trading. So if that sounds a bit confusing, let me explain that with an example, right? So let's say John, right? Let's say John has a margin account with $1,000, and on Monday he buys and sells Apple stocks 1-day trade, that will be counted as a 1-day trade. On Tuesday he buys and sells Tesla stock, and that's the 2nd-day trade, right? On Wednesday he buys and sells, let's say, Exxon stock, right, and that's the 3rd-day trade. On Thursday he buys and sells Microsoft stock, right, that's the 4th-day trade. And since John has made 4 day trades within the 5 business days, his account is gonna be flagged as the pattern day trade rule. And if the account balance goes below 25,000, he will face trading restrictions that we are going to discuss next later in this video. But this was the I wanted to explain how this rule works, right? So in a nutshell, if you basically make these 4 trades in the 5 trading day window, which is excluding the weekends in most of the cases, right? So if you make those 4 trade, then you are gonna be flagged as the pattern day trader, right? So that's the rule that is defined by the SEC, right? So before going further, right, I want to just quickly take 1 minute and explain you the day trade, right? You may have questions about what a day trade is, right? So one simple example is, let's say you start the day with 0 shares of Nvidia. At 10 a.m. you buy 100 shares of Nvidia, and then at 2 p.m. that's just right before the closing, you sell those 100 shares of Nvidia, right? So that's gonna be called as a day trade, right? So that's a simple example. Now one more example, right? So this is gonna be little tricky, right? So you may be confused with this one. So let's say you start the day with 100 shares of Tesla, right? That means you already have that, and then at 11 a.m. you sell 50 shares, right? And at 1 p.m. you buy 50 shares back, and then at 3 p.m. you sell your remaining 100 shares, right? This also counts as the day trade because you completed both a buy and sell of the same stock within the same day, right? So that also is a day trade. So you need to remember, the first example was simple, the second example I specifically chose because this is a little tricky, but both of these cases, that's a day trade. So I hope you're clear now on the day trade and what that pattern day trade rule, right? So with that, let's now move on to the next one. Now the next question is, who does this rule actually apply to, right? So there are some specific cases where this rule applies to. The first one is if your account balance is under 25,000, you are using a margin account, you are subject to the PDT rule. So these two cases has to be true, right? You're basically you are having a balance under 25,000 and you have a margin account, then only you come under this PDT rule. If your account balance is always more than 25,000, you really don't have to care about this rule at all, right? If you maintain a balance more than 25,000, you can just do day trades. You will be flagged as a PDT, but nothing will be restricted, right? So that's what you need to remember. Two key things in this. Basically, if you maintain a 25,000 or more, you can do day trades, or if you have a cash account, not a margin account, then also you are free to do as many day trade as you want, right? So those are the two things. If you fall into one of those things, then you don't have to worry about the PDT rule. Now the important thing, right? What happens if you break this PDT rule, right? So let's discuss that. So if you make more than 3 day trades, like I said, in 5 business days with less than 25,000 in your margin account, your broker is gonna flag your account as a pattern day trader, right? So now once flagged, you must maintain at least 25,000 in your account to continue day trading. So that's the thing. If you have broken that fourth day trade rule that I explained earlier, then you have to maintain that 25,000. Now what happens if you don't maintain, right? If you do not meet that requirement, your broker can restrict your account, right? You may only be allowed to close positions, not open the new one. So that's the first restriction that your broker is gonna impose, right? So, and the second one is your account could be restricted to cash only trades for up to 90 days. So that's the second one. So those two restriction is gonna be imposed if you break that PDT rule and do not maintain that 25,000. Now one caveat there is, most of the brokers allow at least one warning, right? So some brokers is gonna give you a warning or at least one time reset, but if you repeat that violation, you're gonna be leading to those restrictions that we talked about. Robinhood especially does give you one time exception that you can actually request to reset if you break that rule, but repeated violation, you gonna be flagged and then restricted to close only positions if you do not maintain that. And they have the right to sell your stock to maintain that balance, right? So they can do that thing if you break that rule. Now let's see, right, in Robinhood, where you can actually, if you use Robinhood platform, then this section is gonna be very helpful for you. You can actually see the trades, right? So if you go to the accounts and investing, right, and then scroll down to the end, you're gonna see a section like this, which would say the day trades, right? So here, because I have been already flagged as a PDT, but I do not care because I maintain that 25,000. But if you are under that limit of the PDT, you're gonna see those boxes here saying 1 day trade, 2 day trade, and it's gonna be clearly shown as this in this section whether you're gonna be about to break that rule or not, right? And once you break that rule, this is the message that you're gonna see. If you maintain, like I said, above 25,000, you don't care. But if your account is below that, then do come here and see how many day trades you are actually making every day, right? So because sometimes you don't realize, maybe you just made 2 day trades in one single trading day, right? So that's gonna be counted as 2, right, not 1. So, and the next day, if you make again the same 2, then you actually broke that rule, right? So you need to be bit careful about that if your account is below 25,000. Okay, the last thing, right? Now the tips to avoid this PDT rule, right? And number 1 is use a cash account. If you want to avoid this PDT rule completely, just use cash account. Don't go with the margin account. You never have to worry about that, right? So that's number 1. But again, margin account has its benefit. You can actually go a little bit leveraged. So if you have a margin account, then the number 2, right? Then keep your day trades to 3 or fewer in a rolling 5-day period if your balance is under 25,000, right? So that's the number 2. If your balance is under 25,000, then be in that limit. go check the Robinhood I showed you. All the other platform also have a similar interface where you can actually go and check whether you have broken that rule. If your broker does not have, then you have to really keep track of that, right? So that's the number 2. Number 3 is instead of the day trade, right, just wait a day and make it a swing trade, right? So let's say you buy something today, just wait a day, next day sell that stock, right? Then you won't be flagged as this day trader, or you are going to be only flagged this or come under this PDT rule if you buy and sell on the same day. If you buy today, sell tomorrow, that's one option to avoid that, right? Number 4, right, and this is kind of not a preferred way, but still that some people use, that is you can use multiple brokerages, right? So let's say you have a Robinhood account, you have a Webull account, you have maybe let's say Fidelity account, right? You have 3 brokerages, then you have a limit, right? You can 3 day trades you can do in each brokerage, right? So that kind of give you the number of day trades that you can make across the brokerages, because this limit is per brokerage. So that's one loophole or kind of a workaround that you can use to have more day trades available to you, right? Not a preferred way in my opinion, but that's the way. So those are the tips, the way you can actually avoid the pattern day trade rule. So I hope it made it all clear. If you have any questions, definitely put your question down in the comment below and I will reply to that if there is still doubt around this whole PDT rules, right? Okay guys, so that was it for this video. If you have not subscribed yet, do subscribe. I'm gonna make a lot of videos around options and stock trading, and soon I'm gonna come live as well to show my open and closing positions live on as I do the trades. So do subscribe for that. With that, I'm closing this one. Happy investing. Bye bye.